Welcome, welcome, welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn from Focus Compounding on air live with Geoff Gannon. Geoff, how's it going today?
It's going very well, Andrew. How's it going with you?
It's going great. We hope it's going great with everybody else as well. If this is the first time you are tuning in with us, thank you so much for joining us. Be sure to check out all of our content on the internet. If you're watching on YouTube right now, this is focuscompounding.com, which is our free website with investment write-ups and blogs going all the way back to 2005. If you're interested in learning about our money management services, you could click that Invest With Us tab, and it will take you to a page where you could learn everything you want to learn about that. And of course, follow me on Twitter at Focused Compound, which is the best place to get everything that we push out into the world. If you like the email segment of this podcast where we take listener emails and discuss them on the pod, you could shoot over an email to focuscompounding@gmail.com. Keep it concise. And if it's a common question or something I think a lot of people could benefit from, we will pull it for the podcast and go over it on our weekly show. So last week's pod, Geoff, we spent a lot of time talking about Ted Weschler's investment in Dillards. And then the next day, I was getting some emails from people, and I actually got one from you as well, because the Wall Street Journal, they actually put up an article on Dillards titled, "This Department Store Stock Has Trounced Apple, Amazon, and Tesla." My question is to you, Geoff, to people from the Wall Street Journal, do they listen to the podcast? What do you think? This was one day after. I mean, I kind of tweeted it out joking, but I was like, this is, I was like, there's some like more in-depth research here. They're reaching out to people and stuff. So odds of that happening, no, just kind of a funny coincidence. But what did you think of this article? Kind of funny timing, huh?
Yeah, it was funny timing. And actually, after the podcast, I also looked at Dillards for what things like we hadn't talked about. And because as we were recording, there was also things I was noticing on QuickFS and everything that we didn't spend much time talking about. We talked about how cheap it was, basically in terms of free cash flow to enterprise value and in terms of like price per square foot. We didn't talk about the fact that I think for 7 or 8 years, their SG&A in dollar spending is about the same as it was like 8 years ago or something, which is, they're down to about the same levels. Whereas we've talked about like Village Supermarket, and I've said, actually their performance probably on a gross basis may even be a little better than Dillard's, but the constant increase in SG&A over 10 years or something is their problem. Obviously Amazon, that's their problem, is a lot of added expenses. So even if they grow a little bit now, their earnings go down because they have such rapid increases in expenses. And then the other thing which we touched on, which you highlighted when we were talking about, but we didn't go into a lot of discussion of, is the incredible amount of buybacks over the years. And both of those things were obvious before COVID. They had good SG&A control before COVID. And then also they had heavy buybacks. They were on a list of like the most companies that buy back the most stock.
Do you think you see that more so in family-ran businesses? I mean, this is essentially a family-ran company. Owner, operator, pass it down to his kids. Do you think that's more common in that? I mean, or is that not necessarily true? Because we've spoken a lot about Village, for example, that is a family-ran business. And, well, they actually haven't managed their cost structure as good as you would like to see.
Yeah. I think, well, I mean, in terms of the buybacks, I think you see just like unusual capital allocation for family more likely. So sometimes that means not issuing shares. Sometimes that means buying back. And sometimes that means, doing other things like just hoarding cash and stuff like that. In terms of the SG&A, I don't know. Some are good at it, some aren't. It probably depends on their background there. Companies like Village and Walmart and some others would have had okay sort of performance if they had been able to manage their expenses better, as well as Dillard's. Obviously, Dillard's is extreme though, because to be able to keep your SG&A at the same level that it was a long time ago is very hard to do. The other thing, if we go to the cash flow statement, I think we can see this, because this jumped out at me, I believe, if this is right. Yeah. So where do you see the line for stock-based compensation?
It is not on here on QuickFS.
Right. Which means that they're not issuing stock options.
Mhm.
So, that's huge and uncommon, right?
Mhm.
I mean,
Mhm.
Amazon is a good example. Amazon, if they didn't issue stock, would be obviously having much better results. So just huge differences there. So,
do you think, I think it's interesting to sort of explain why the whole stock-based comp thing is a sham and how companies sort of manipulate the whole thing so it doesn't show up in their earnings. So let's say, for example, they're going to hire somebody for, $1 million in total comp. They may give you like what, $250,000 or $500,000 or whatever the numbers are in cash today that flows through the income statement, but then they'll also issue you perhaps the other half or the other 750 that you could go around and sell today in the market. So it's basically the same amount. Of course, you could hold it, but perhaps you're going to sell it today. And then, of course, that doesn't have to run through their income statement. So in total, you're being compensated $1 million or whatever numbers you want to use. But of course, the companies, they just don't have to show that in their earnings because, well, they only have to show the 250 or 500 they paid you. The other 750 or 500 that was given to you in stock that you sold in the open market, well, that runs through the cash flow statement there. However, from an EPS perspective and what Wall Street and analysts and everybody cares about, well, it doesn't have to run through the income statement, which is why Buffett's been criticizing stock-based comp for, years now.
Right. So going back 20 years or something, it wouldn't have hurt your earnings. Now what's happened is that companies basically don't report earnings, companies like Amazon and stuff, or people ignore the earnings. So we look at two things, which is some form of adjusted EBITDA usually, which takes out stock-based compensation, and free cash flow. And this is a warning that I have when we look at the free cash flow thing, is that many people are calculating free cash flow by using cash flow from operations minus CapEx. So like on a line like this, they would go, okay, well, cash flow from operations was whatever in 2023. Then I go to property, plant, and equipment. I subtract that out. What I'm left over with is free cash flow. And that wouldn't be a very bad guess if there wasn't stock-based compensation. But the problem is that the amount of shares is going to go up or down over time. And if it goes up over time, then that's a constant lag in your investment results. So if you have a company, it could be Amazon or whatever, if it issues a couple % of the company every year, you can certainly say, I'll deal with that separately. And I think that's a good way of doing it, of saying, I'm not going to take it at the price, because there's complications as to how it's adjusted for, saying how much the charge is. And I think that that's unrealistic to some extent. So the problems are, there's a couple problems. One is, obviously, if I'm interested in buying the stock, I actually think the stock is worth more than it's shown for anywhere on the statements, because I'm appraising it at a higher level, presumably. Sort of like how I say you should always be in favor of a buyback instead of a dividend in a stock you own, because if you really just want the dividend, you should sell the stock, because if it's so overvalued, why are you holding it? Same logic. It's not that everyone should, that anyone who issues stock, that it's actually issuing stock that's undervalued. But if you're buying the company, which is when we're talking this podcast, that's what people are usually looking for, is a stock to buy. The stock-based compensation is actually even worse than it appears to be. So a good way of doing it is, how much do they dilute in percentage terms over time? Because that's something that's easy for people to kind of do the math on. Okay, well, if they dilute by 2.5% all the time, and I'm going to own it, and I think I'm going to get a 13% return. Okay, well, now I'm going to get a 10.5% return. That sort of way of doing it might work. Then the other thing is, obviously, if the company's results slow down, do they have to issue more? Do they have to change how they compensate people? All of that. And that is an issue for like growth companies and stuff. It's obviously not an issue for these kinds of companies. But what's a big problem over time is that the stock option thing has become very pervasive, so that even at smaller companies, family-controlled companies, whatever, it's become common to have some stock issued to other people, and even if it's not much of a growth company or anything like that. So it's not just for companies that weren't making a lot of money, didn't have a lot of cash to pay, are in Silicon Valley, whatever, where they need to incentivize certain people. They don't want to give them actual ownership in the founding, but they want them to think like a founder and to bring them on in a way to draw them away from high positions at other companies, whatever. That was one thing, and that either makes sense or doesn't, but it's more of a venture type thing. It's moved so that it's common that we see it now at all companies, basically. There's some, it's often significant, often about 1% of the company, dilution happening at companies that are old companies that are in industries where this isn't necessary and are giving it to top executives, including executives sometimes who own stock and already, or are connected in some way to family or whatever. It's probably not necessary to do it. And obviously, it's a bigger problem if the stock is undervalued and if you want to buy into it, and it can be a real drag. There can be a significant difference with a company that never issues stock versus one that does. So it's something to keep in mind.
Totally. And if you were running a company, I mean, you would just set up a bonus pool of some sort, correct? Typically the way you would think about it.
Yeah, probably. I mean, I don't know what I would do if I was starting a company that was, a tech startup or something, because there's not a lot that you can do that way. But, Berkshire Hathaway doesn't issue stock options, obviously. So, and yet they compensate some people very highly. So it's possible to have very high compensation without issuing shares to people.
And the stock-based comp scheme that I spoke about a few minutes ago as well. I mean, oftentimes these companies will actually buy back the stock from the people that they're actually issuing it to as well, which really sometimes you see individuals quote, well, the company's buying back a lot of stock, but then when you kind of do the math on it, it's not actually, the share count isn't actually going down because they're just buying back shares that they were issuing, which is why Geoff had said it's good to track the dilution over time. And because this always gets brought up as well, Geoff, when you're projecting what a company could be worth, 5 years, 10 years, whatever, you are carrying out that dilution going forward if the company has done it, for the past 10 years and, you expect it to continue to happen, you will also adjust for that going forward when you're thinking about like the valuation of what the business is worth. Correct?
Yeah, that's correct. There's a company that I probably would have bought if it wasn't for how much dilution there was. So it does. I mean, there's been a case where that it's been enough, where the return seemed comfortably 10% type return, and then I think that
is it Tesla
get 6 or 7%. No, it's not Tesla. But so it's it's a completely science-based company. That is hiring people with advanced degrees and stuff, and is giving them a lot of stock, and has since the beginning of the company. But as a result, it's only a so-so investment for outside shareholders. But it's a pretty good deal for the people who manage to get hired by the company. So, because it's a good company, but they also get the stock at without having to buy it in the market.
So I thought this article was interesting. One of the parts that was they were talking about before the I'm not going to say the C word because then you get you get flagged on Spotify and YouTube. I'm not going to say it, but before the event that happened that started with a C, Dillards suffered from the same habit of overbuying and discounting that plagued other retailers. The people said it thinned out its inventory during the pandemic and stayed lean as other chains overbought last year and wound up with too much stuff. We've spoken a lot about that last summer. One way Dillards avoided that fate was by preaching the value of light inventories to its merchandise buyers. Its vice president of accounting recently met with buyers throughout the country to explain how excess goods hurt the bottom line. Company spokeswoman Julie Guyman said the company's inventories is down 23.5% in the fiscal year that ended Jan 28th compared with 2019. Meanwhile, profits totaled $891.6 million in the latest fiscal year, up more than 700% compared with the same period in 2019, far outpacing rivals. So I thought that was interesting that, the whole 700% increase in stuff, whatever, but just the fact that they're being more conscious of their cash flow and are purchasing, inventories consciously to not overbuy and then have to actually discount and do Target and Walmart and a bunch of other retailers had to do last summer.
Yeah, we've talked about this before. Dillard sells a lot of clothing, things like that. At the original markups on them, those have good gross margins, but because they are so highly perishable, they're fashion risk and seasonal risk and things like that, you end up selling them at much lower levels because you have a bunch of it sell out on clearance and stuff like that, which leads you to have low gross margins. So that's the problem that you have. You have high obsolescence for that. So if you didn't have that problem, which like that's the idea of the fast fashion companies and stuff, is to try to avoid that problem, then you'd be able to have similar original pricing, but it wouldn't look like you're more expensive, but actually be making more profit over time because you're selling more of it as you originally intended instead of selling it to clear it out. Because when Walmart or Target or any of those say that we're going to clear out inventory, the way that they're doing that is they're putting things on clearance. They're doing different stuff to drive that to happen. So bad pricing for that.
And then they also said that the store hours have been reduced as well, which we talked a lot about that too, right? Do you think eventually things will go back to being open longer, kind of how they were pre-COVID, as soon as competitors do that? Or do you think that's here to stay?
No, I think that's significantly here to stay because a lot of it makes a lot more sense. I mean, it depends on what the unemployment situation is. If eventually unemployment can be a lot higher, then it's a different story. But I think it's interesting. Companies like Dillard's and some other ones will realize that they don't need to be open that much, obviously. They also can sell both online and offline, and to be able to be more effective doing that than companies that sell just online or just offline, which means that you could reduce your hours. You could reduce some locations to be further away and kind of think about how you're going to do that. So I think some things like department stores and movie theaters, which we talked about, car dealers, I think too, that are large groups at least of car dealers, can think seriously about can we reduce our footprint by a lot? Can we operate with 3/4 of the number of locations or something if we have people come further to it? Can we operate with fewer hours? And can we operate with part of the process online and part of the process offline? I think that will be something that does permanently change from what we had before. Some of the others I don't know. Obviously, if they really want higher sales and eventually it's easier to hire people, then they could expand their hours. But a lot of things, it didn't make a ton of sense for them to do the hours that they did. And, historically, there used to be a lot shorter hours in a lot of these stores. The tradition for a lot of these was for much, much shorter hours. And then they copied more of the Walmarts and the Targets, things like that. And what we're talking about now is just we're talking about basically these companies operating like department stores had, instead of seeing themselves as just competing with these things, which are, Walmart is a completely different business than a department store.
So somebody actually shot me a text. I'm not going to name any names, but somebody that, knows Ted or talked to Ted, or knows somebody that knows Ted or talked to Ted. So maybe a little bit, telephone game here. But the text said, just listen to your chat on DDS. I have a friend who talked to Ted, blah, blah, blah. He said he got the DDS idea while reading through BJ wholesale conference call transcripts and noticed they were selling some real estate or doing some kind of leaseback transaction or something similar. But the funniest thing about the conversation he had is he told Warren he wanted to buy Dillard's. And he said, Warren thought I was crazy. Laughing face. So
yeah. Well,
Warren thought he was crazy.
They had, so that's one thing we didn't talk about too, is it's possible that, we don't know, but it's possible that Ted has invested more in retail, depending on how you cut up the who owns what, right? Because, for instance, Berkshire Hathaway has a holding in RH, Restoration Hardware. We could guess who that is. It's not Buffett. They obviously, you heard the interview where he did with Nebraska Furniture Mart, right? So there could be some awareness of things that are different from like Buffett and Munger. One thing I talked about with Munger and Alibaba is that Buffett and Munger's record in retail is not very good. Their record in more general retail, department stores, things like that is bad. And that's obviously a part of what you're talking about there. So I think a big part of that is it's not I guess you could say it's not an easy business or something, but of course, Buffett hasn't had as much problems investing in financial things where the operator made a lot of difference. The thing with the retail stuff is that it makes a huge difference who's running the business, right? So, which you can get if you read like, what's the Sam Walton biography?
Made in America?
Made in America, yeah. So, I think we've pointed out before, like, Walmart hasn't been an amazing stock since Sam Walton died. And it's obviously run differently since then over time. Now, it was run somewhat differently throughout his life too, but it would have probably done different things if he had lived for a long time, or if someone else like him was running it. And I definitely mentioned associate cotton shops with Berkshire and how quickly it fell apart and stuff after they had someone else come in. But they've had that problem in insurance things too. So, Buffett's been able to judge people well enough in insurance things and stuff where they've occasionally had to replace someone because things rapidly deteriorate after they lost a founder or something. But in retail, it hasn't worked out as well.
Interesting. Well, I had a lot of fun talking about that investment. So we could talk about the current market and where we currently are on the year. The S&P 500 up 3.8%, 10-year yield. It was up above 4%, but we're currently at 3.94%. Crude oil, $77, and natural gas, Jeff, yes. 2.62.
Yeah, I thought your
brains were blown out. I mean, I think in the summertime. I know it's like what CNBC does, right? Like when Bitcoin was higher, that's right. Like on their watch list stuff. And as soon as it's not, well, you just take it out. But no, we're gonna stay consistent here. I mean, we were talking $7 like last summer. Yep. And here we are, warmer winter, inventory's up a little bit, and you could see just the swings in natural gas. I mean, I actually was curious and looked a few weeks ago at just the average swings that natural gas has from year to year. And it's like up 50, down 50, up 60, down 60, up, blah, blah, blah. I mean, the most volatile asset ever. And of course, the leverage that you get with it as well. But pretty crazy, right? I mean, $2.62. And I think, last time we actually went over this current market thing, we were at, above $6 or around $7.
With not a huge difference in oil, right? So, I mean, that's the other thing is that you'd think, oh, natural gas and oil, what is it? You're buying some oil company and, it's got natural gas and oil. Oh, well, what does it matter which form it comes in and stuff? So you've had, I don't know, 20% or something move in crude oil when you've had almost an 80% move or something in natural gas at times. I guess the 2-year has moved more than 10. So, that's the more significant development lately in the market is shorter term interest rates have increased, yields and stuff have increased quite a bit more. And there's been an adjustment in people's assessment of there you go. You got your terminal rate and all of that. So, yep.
That's right. Pulled from the daily shot. The 2-year treasury yield rose above 5%. Pushing the treasury curve into deeper inversion territory, which I moved deeper into inversion territory. Anyways, but 2-year has risen pretty drastically. And we could go over that really quickly because we haven't talked about rates in some episodes. Chair Powell, he struck a hawkish tone in front of Congress and basically talking about faster rate hikes. He said if the totality of the data were to indicate that faster tightening is warranted, we would be prepared to increase the pace of rate hikes. Him and Elizabeth Warren were going at it. Basically, she was saying, well, if you do this, 2 million jobs are 2 million people are going to be laid off. What would you say to those 2 million people? And he said something like along the lines of, well, if we don't do our job, then everybody is going to continue to experience 5 to 6% inflation. Higher terminal rate, Powell, the latest economic data have come in stronger than expected, which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated. And then the probability of a 50 basis point hike this month has basically been locked in. It has surged. It's pretty crazy, right? Like you read about from the 70s time frame, just how hard it is to get inflation down and how entrenched it can become. And we're living through it right now. I mean, do you have any general thoughts on inflation data, interest rates, where we currently are in the curve, and just, thoughts on that in general?
Not really. I mean, we've talked about this before. I'm biased towards. I've expected higher rates more than the market has consistently. So I think that my expectations would be out of the range of what people would normally be expecting. So I don't think that I can be very objective about all of that. They're getting to levels that are not, in terms of what the implied terminal rate is and stuff, that aren't that far from what we talked about early on. You're talking about 5.5% or something. We talked about 6% or something. The main thing is, there's a bunch of articles written about like, oh, well, what if inflation is this high? This isn't, can we adjust the inflation targeting? Can we do this or that? What if we measure inflation differently? What if all these things about inflation? It actually doesn't matter right now, because if the Fed didn't know what inflation was, they would still know what the unemployment rate was. And they would know that they need to raise rates quite a bit, because the suggested, like when we did things where I said, well, the rule of thumb would say you need to be, various rules of thumb would say you need to be between 6 and 10% early on. A large part of that is because of things like the unemployment rate. You can do things where you say, okay, I don't know what inflation is, but what do I need to do, trying to come up with other sorts of numbers. And I think the Fed would say that the unemployment rate needs to settle at the boom part of a cycle, at almost 1 point higher than where it is now. And that probably you need to raise unemployment by 1 to 1.5% or something from where you are now. Now, people could rejoin the workforce and whatever. The unemployment rate is not maybe the best measure of the labor force, how it's being utilized and stuff. But if that's what we're going on, then it needs to be quite a bit higher. To be that much higher, you can say, well, how much do you normally need to increase interest rates to cause an additional increase of 1 or 1.5% unemployment or something? That's quite a bit higher than where we are now. Now you could say, okay, well, there's a lag. Maybe that's the reason. And then you go back and say, okay, how big is the lag? How far back do we go that hasn't trickled through to the unemployment rate? But regardless, you kind of end up with numbers that you have to raise the unemployment rate. Because if you don't raise the unemployment rate, it's unclear how you would be able to have the economy grow as you want it to without causing inflation, right? So this is kind of what we talked about in the past. I've even heard people talk about like the no landing scenario, right? But that's kind of the illogic of it, which is, okay, what if we don't have a recession and inflation comes down? Well, it's unclear how that would work, because you don't have slack in terms of labor. So how would you be growing without causing inflation? That's the problem. Unless something's very different, where they are able to have major changes, which we talked about before, the Fed has assumed for a while that that it wasn't a problem running with a very low unemployment rate. And that really started around 2017 or so, where they had the unemployment rate was too low relative to interest rates, or interest rates were kept too low relative to the unemployment rate. At that time, there wasn't a lot of inflation. So if you're using inflation targeting stuff, you'd say, okay, this is fine. But it was an inappropriate rate for the level of unemployment. And in the longer run, maybe it makes more sense to think about the interest rate and the unemployment rate and things like that, instead of looking at the rate of inflation currently. Historically, interest rate targeting inflation targeting isn't really been what central banks have done all the time. I think the first times that banks start doing that is in the 90s, and it's not the Federal Reserve for a long time more. So it's something that you could, move away from and start talking about other things. And probably it would be a lot better if they weren't talking all the time about what inflation is and just saying, look, there's too much on it. I mean, I wrote down the number that you said. If Senator Warren said 2 million people, that's probably not wrong. You probably do need to throw 2 million people out of work to be able to slow inflation. I mean, that number sounds about right when I divide it into the workforce and everything, that you're overemployed by 2 million people have jobs who you shouldn't have jobs right now. And if you don't do something about that, then you won't be able to grow the economy without having inflation.
Do you think this just shows how important it is for the Fed to be independent of other parts of government? Because here we are. I mean, inflation is already, I mean, it's a huge issue, and there's extreme backlash towards the Fed because people are going to get laid off and they're going to price us into a recession, right, to slow things down. I mean, my biggest takeaway was just how important it is for the Fed to remain independent, because politicians, they would be like just continuing to run the gun because they don't want people to be laid off and to push us into a recession.
I think the press overstates the kind of idea that they did this during the Trump years, this is unprecedented that a president has been saying this and stuff. It's not unprecedented. The only presidents who respected the independence of the Fed were Clinton, George W. Bush, the second, and Obama. Those were the only ones. No other presidents stayed out of it. They all interfered a lot, some much worse than modern ones. I think
it was funny on David Rubenstein when he had said that Trump would call Jay Powell often, or he would talk to him often.
Yeah, well, the most famous one is with Johnson. So Johnson met with a head of the Fed, and then lied about what was said in the meeting. Came out first and said, they put out a press thing first and said what had been discussed, which was not what had been discussed, what had been agreed, which wasn't what had been agreed. And so you're stuck with it, right? So that, in fact, is why when Powell met with Trump, they had to say what they were talking about, agree on the statement before they agreed to the meeting, which is what they do in like diplomatic meetings and stuff. You agree to the statement you'll put out to the press before you actually have your meeting. So, when they have the president of the United States and the prime minister of whatever country there, and they meet, it's actually been decided beforehand by aides and stuff what the exact statement will be put out, and then they're allowed to have their meeting. So, same sort of thing. Yeah, I mean, obviously politicians are for, not all politicians, but some politicians are going to be for looser policy. The other issue you have is that you don't have a very long period worldwide, in the United States and in other countries, where you are completely untethered to any sort of rules that you have with currencies and things like that. So we really only have, since the beginning of the 70s to today, to judge what can happen with central banks and how much inflation you can have. And we've had now 2 bad episodes. That's not a very long period of time to have 2 episodes in half a century. So unless this gets underhand fast, it does become really worrying that the whole central banking thing, when it's not connected to any sort of gold standard, any sort of standard in which there is a relationship between other currencies, as you had with other currencies in the US dollar, and then the possibility that the US dollar could be converted to gold from large holders from other central banks. If there's nothing there, which has only existed for about 50 years, then it seems like there's a lot of trouble that governments have. And the United States has basically run a deficit fiscal all the time since then. So it had one brief period around 2000 where that wasn't true. But prior to that, it sometimes ran surpluses. And on a net basis, often it didn't have one or the other. A few years earlier, it started running them. But so if you think about it, in the last 50 years, you may have had too loose policy from the central banks, and you certainly have had a willingness to run deficits. And then it may be even worse in some cases in like Europe and stuff, where you have countries that both are running deficits for a while, that have run deficits, while also probably not meeting obligations for like defense spending. So that, with Ukraine, this is an issue. They're likely going to meet their NATO targets at some point, which requires them to spend a certain amount of GDP. If they've been running a deficit when they weren't even doing that, then basically that's telling you that everyone's kind of structurally thinks that normal is running a significant deficit. And a deficit on its own isn't that big a deal. But if the expectation is that you'll always run a deficit, in normal times. So not that you'll run a deficit after a bust, after a financial crisis, when you have a lot of unemployment, when you're fighting a war, but that you'll run it pretty regularly, then expectations would change a lot in terms of what inflation would be. And so eventually there could be high expectations. You could be shifting to a situation where there's high expectations of inflation ongoing forever, that wouldn't be unbelievable. And we've talked about why that is before, but basically, with like the United States, for instance, a lot of the measures of inflation are incorporating things from other countries. So durable goods, things that happen to come from China, where they had a very different situation, too much in terms of like too much manufacturing capacity and stuff. So that was deflationary, and that is sort of imported. If we look at things like the sticky inflation stuff, the service things, the locally produced things, we don't see the same, we never saw the same level of like almost 0% inflation. We saw like 2%, 2 to 3% inflation throughout the 2010s, which supposedly was the period in which inflation was too low. And that was coming out of a huge financial crisis where you'd normally have deflation. So, I don't know, except that at some point, the reason why they're worried about this and stuff is at some point there's major implications for this if everyone realizes that, like what you're talking about, the issue is it's not just like, say, political pressure. It's to some extent, I mean, even the people who don't have who aren't applying political pressure and saying to the Fed, oh, go ahead, raise it, that's great, whatever, are basically saying, well, that does our job for us. We don't have to not run a deficit because you'll have higher rates. And the Fed always says that theoretically they control inflation, that they can set they can set an interest rate to achieve any level of inflation that they want, which is kind of true. But obviously it depends on what the fiscal policy is. And so it just means that it's a theoretical possibility that that to however big the deficit and stuff, you could raise interest rates to offset that. I mean, the two are related. So I think that the long-term expectations of the two are related. And over time, there might be a shift in what those expectations are because they're very mild right now. So if you look, like when we look at things like 10-year and stuff, like 10 years too low. The yield on the 10-year looks inappropriately low. So like historically, it wouldn't be odd to see a country's 10-year yield and its nominal GDP growth rate be about the same, the expectations for the two. So if you think that the country is going to grow GDP by like 10% a year nominal, inflation plus its real GDP growth, then it would make sense that it's be 4% or something. But so that's baking in on the 10-year almost no inflation or almost no growth, one or the other, that a very low combination. It could be 2% inflation and 2% growth or something, and then it's not way off. But it's certainly assuming that kind of thing, that it gets back to a fairly low level fairly fast, which might not be wrong. But it just means that certainly there hasn't been a big shift in people's longer term expectations. We've seen the big shift in the short term realization of inflation that's going on now, but people have reacted fairly like it's a temporary thing, which it very well may be.
So if inflation just rolls off and there's this soft landing, do you think the Fed would cut interest rates again to stimulate growth? Or do you think those interest rates that we saw over the past couple of years were just a complete aberration that we won't see again until there's another panic?
Both. So I think that they are, and that they wouldn't do that again. However, we're kind of in uncharted territory. The Fed has never, that I can think of, seen an inversion like this and not cut. I can't think of one, but some listeners might be able to think of one where we've been inverted by like a full point like this for this long and not cut. The Fed cuts every time they invert the curve meaningfully. So there hasn't been a recession yet that anyone's announced. So, but certainly, yeah, every time there's a recession, they cut every time there's a yield curve inversion like this, there's a recession. So, it's never happened that we've had a recession and they just haven't cut in modern times like this. And it's never happened that we've had a yield curve inversion like this and they haven't cut. So we're in uncharted territory in a few different ways. But yeah, I mean, they always cut. That's always been what happened. As soon as basically, I mean, there have been occasional situations where unemployment has moved up slightly that I can think of. A recession has not resulted. These are very, very small increases in unemployment. And the Fed has not cut. I don't know what cases that is other than Greenspan, but there might be some. And so it is possible. But, I think that it's almost certain that they will cut rates. And that's probably why the rates that you saw expected such a quick stop from the Fed is if they're predicting recession, then they expect them to start cutting immediately because that's what they've always done in the past.
So, I mean, if you think rates are here for longer, higher rates are here for longer, do you think bank stocks are looking cheap, or what are your thoughts on financials in general? I mean, if you look at like JP Morgan, 1.4 times book, you look at Bank of America, I think we're at like 1 times book. You could go down the line. Are we back to looking cheap again for banks, kind of back to circa 2020 timeframe when banks looked cheap? I mean, Wells Fargo, 0.9 times book value. You can just go down the line and we're kind of starting to tick down again.
So this is the area in which we're in the biggest uncharted territory, which we mentioned before. So I'm going to, bring up something that I bring up on this podcast sometimes, which now is never mentioned by the Fed. They never mention the statistic, but it used to be the main statistic they talked about like 40 years ago, last time there was bad inflation. Money supply. So money supply, by most measures that we would use, has declined in the last year by basically all measures that you use, and has declined a bit more rapidly in the last few months than it did in like the early part of a year, which is almost unprecedented. It has happened before briefly, but it's certainly interesting, for instance, that, so for instance, there's comparisons between the United States and China. Like, why is the United States growing this way? Why is China growing this way? Something to keep in mind is that if you think about the money supply growth and everything, it's not clear that China's economy is currently, the potential growth and all that is a lot greater than the United States. Under the same monetary conditions, the United States might be growing faster than China right now. China is growing at a very modest rate. Now, we'll see when they open up and everything if it becomes much more rapid. Very, very modest rate relative to a high level of money supply growth. The United States should not be growing at all. And so that's part of the worrying thing here, of why is it growing? Why is there any growth? How is it happening that you're having growth when you have money supply contraction like this? And how quickly could it reverse? One possibility is that you could have too much of a reversal pretty easily. Because, the economy is not in recession as far as we know in the last quarter. Despite the fact that you've had trends in homes that are pretty unusual outside of a recession for a year now. So there are things like that could reverse quickly. And that's why you would be careful about cutting too much, about why you could start a lot of inflation and stuff, is that you could have a disproportionate effect on those sorts of things and not a very large effect on others. So the issue for the banks is, I think it depends on what kind of bank. I think there's much greater danger of lending long-term and having trouble getting deposits than people realize. And I think watching deposit trends and stuff is meaningful. And so banks that have a lot of low-cost deposits that are very sticky, that they're likely to be able to hold on to and stuff, companies like Bank of America, would be in a better position. And companies that have a lot of short-term investments, money left at the Fed, loans that come back to you quicker in terms of payments, and less tied to long-term things and real estate and all of that, are probably in a better situation. Banks that don't have a lot of deposits, that are that reliable, that's not where their real franchise is, and that are lending a lot to like longer-term real estate things and stuff like that, I think it could be a problem. And eventually we could see some problems for banks from this, which we haven't seen in a very long time. We haven't seen mismatches between funding and between assets and liability stuff cause any meaningful bank failures in many, many decades. I mean, you can almost count which ones have happened purely for that reason, and it's a small, tiny, meaningless fraction. And that would be more the issue here than something like than something like delinquencies and stuff. There is some stuff that is also worrying in terms of how expensive things have gotten. So you could see unusual trends there. So I think, like we talked about Ally Financial, right? So they're involved in like auto lending. You have very high delinquencies in auto lending for a period in which everyone's employed. And it's interesting what the severity of those losses will be too for them, for Car-Mart, for any of those, because of how expensive it's been gotten. I think you could. So cars are the big one there. I don't know that much about housing because in the United States there's so little debt in that area, and so little of it reprices that I don't know that it's a huge problem. And I don't know how big an effect that has because most people, there's been so few homes being sold, really. It's not like, we've seen a boom in terms of home prices, but we haven't seen a boom in terms of the number of people getting into new mortgage stuff like that. It's really other countries that are the bigger risk there. But home prices are obviously very elevated versus people's earnings and stuff. And so we'll see about that. But, like I was looking at Greenberg Partners, right? And I think they said their median home sold in the quarter was $580,000. That's not sustainable.
It's crazy.
Yeah. So who knows? But that's difficult if that's what because eventually people will have to have different interest rates on that. If those are their new homes being sold, then they do have different interest rates on that. And that would make it very expensive in some places. And that's why you have, these articles about people making over $100,000 and living paycheck to paycheck is because they're taking out a mortgage on a $580,000 home. So there's not much left over in disposable income. So, there's a lot of inflation, like asset inflation stuff that might be worrying. I think more in car than home probably. So that doesn't affect that many banks. Like that's not a huge lending section. It's not something that you'd worry a lot about. But for those that it does, like we talk about America's Car-Mart, which is not a bank, but is exposed to that. And there are other ones that do that. I think it's worrying, but we've talked about that trend for a long time, that it's worrying. It's gotten very expensive. And then that's also a risk for other kinds of car companies, right? So that's a risk for your Teslas and things like that, because Tesla may be a great value versus other cars, generally for all the things you want. What it's not a great value for, though, is basic transportation, which kind of puts a floor underneath the need for buying in the United States. There's not a lot of public transportation. People don't live around there. They need to get to work, things, whatever. So there's all the kinds of cars that Car-Mart sells in rural areas. There's always demand for. But the gap has gotten pretty big between a 9-year-old used car and some new cars. And I mentioned Tesla just because obviously Tesla is, because of the fact it's electric and stuff, just doesn't work well as a choice for that. It would be something that you'd obviously avoid and stuff. So I think that is a potential problem there. And we'll see how it goes. And then, of course, for things like America's Car-Mart, they also need funding because they don't have deposits, and Ally over time, that's shifted, but we've talked about that before too. So their costs used to be very low, borrowing at corporate level and doing that. So their business used to be a lot better that way. On the other hand, it may cut down on competition in the long run for them. So we'll see. But yeah, they're definitely will be stressed by this.
What about just more traditional banking models then that, like I said, don't have exposure to car lending as much? So your Bank of America's, JP Morgan does a bunch of different things, but just the typical larger bank.
I think you have to look at them and decide. I think things that have very strong deposits are desirable.
So it's back to that.
The stronger the deposits and the shorter they lend is the better. So, so like we talked about Frost's expectations for the year are based on what their earnings expectations for the year were based on Fed funds rates being at a certain level, which was the previous expectations. So if they were to run ahead of that, then their earnings would be even higher, and they might earn more than $11 a share or whatever. So that would make them not that expensive. But the expectation obviously is it would come down fast from there. So, but those kinds of banks are a good example, because generally if you raise rates a bit, you can retain a lot of deposits, right? And you can retain a lot of deposits in the bank with that. There are other ones which that are harder to predict. Like I think we talked, Berkshire's big ones are Bank of America and American Express. I would have to look much more closely at American Express to see, but obviously they're not lending long term. So a business that generates float becomes a lot more attractive. We haven't talked about that, but so there's offsets with that. I think we talked about like title insurance has been badly affected.
Interest rates on the effect of float.
Yeah. So something like Investors Title or something has had a huge drop in terms of their title insurance underwriting business, but they hold money at all times, small amounts, which used to be earning about 0%, and now will earn much higher. So the mix has shifted. So while the results are much worse, the mix will also shift so that more comes in a financial form. And that will be true for lots of things. So anything that generates float will have a benefit from this. That's meaningful. That's very meaningful. Because people were ignoring it when it was earning 1%, but if it earns 5%, then it's 5 times more. It will start to be very significant. We did that even where I talked about Berkshire last week, basically saying, look, just people ignore the float. Even if they're not buying stocks with the float, it's significant. Because at this point, you're going to get 5% or something, even if you're not taking any risk in terms of how far out you're buying bonds and things. So just having cash at this point is, we'll see. But we don't know that having cash from having float, which is not money that you yourself have, so customer money, and earning a percentage on that may be better than, say, borrowing and owning the S&P. So it's a low risk thing, and yet it might have returns like that. So far, we'll see. But the S&P would have to do 5% for the year or whatever to match the short term rates right now, and float is other people's money. It's not your own money, so it's a lot more attractive in terms of earnings from that. So there's different businesses that have that, and I'd have to look at American Express, but different companies have some float, and usually it's ignored. Progressive historically was ignored because they didn't buy longer term things. So we mentioned a company, Global Indemnity. They had a really weird one where they, so they're an insurance company. They sold off some insurance business, and they sold basically all of their longer term assets and went to cash at the maybe end of, not even quite the end of last year, but a while ago. And so their results will look a lot better than other insurance companies, because other insurance companies will get hit a lot from that. So, but that was pure market timing type thing that they decided to do, and unusual.
So if you're looking at this company, where would you even start? If it was like, we just pull it up on QuickFS. Maybe take us through a walkthrough. People ask about insurance all the time on the podcast, and if you think float is, we know float is more beneficial when rates are higher. What would you be looking for with a fresh set of eyes?
Well, I'm not sure you could tell from QuickFS. I think we talked about this. This says on PLC, right? I'm reading that right on QuickFS. Yeah. Mm-hmm. However, it's actually an LLC. Yeah. So it's actually an LLC. It's an offshore company. So that's a problem for everybody. That they're usually not going to invest in a publicly traded LLC. The thing with this one is I believe the controlling shareholder is like obsessed with taxes and stuff. He's quite an unusual person, I think. I think his background's in tax stuff, and that's the reason why it was offshore and everything, and why I think some things were done that way. But I think they're changing a bunch of things. The only thing that interested me about that company is reading the actual filings. So they fired the main people who are running things and stuff and replaced them with other people. So they've changed a lot, and it's not very consistent that way. But just looking at reserves development over time and changes in what businesses they sold off and what ones they kept, made it more interesting. So, but it was purely from that perspective, not from the perspective of of anything else. So what businesses they were exiting, and then so they exit this business. Usually what they're doing is they're getting rid of their liabilities by giving them to someone else in exchange for basically getting very little or nothing for the business. But they're able to remove all of that for a business that has a combined ratio that's 100 or more a lot of the time, and then keeping a business that looks different from that. And what they've slimmed down to on the stuff that they're underwriting is a little more predictable, easier to figure out what it might be worth. And then their assets are much better positioned compared to other insurance companies. And then the stock is below book, where some insurance companies are above book. So, so just like reading the filings and stuff, it looked interesting. But like I said, it's a very unusual behavior, and I think it's because of the controlling shareholder.
Cool. All right. Well, we can move on. Did you see this Form 4 come out? Buffett, he bought another 5.8 million shares of Occidental between last Friday and Tuesday. He now owns just over 200 million shares, or about 22% of the shares outstanding.
Do you know what prices it was done at?
Yeah, maybe between $59.84 and $61.56.
Okay. Yeah,
so he continues to buy.
Yeah. I think he'll buy it like less than 65 or something. 55, 65. Like he'd just been buying all the time when it's there. I don't know. I haven't seen what the stock was recently, but I know that not that long ago, when he wasn't buying, it was above the prices that he had been buying before.
Do you think this is a signal to perhaps go and look at other similar companies that are more off the beaten path, perhaps smaller, that Buffett would not be able to invest in? But did you look at this as like a good signal to go find some other companies?
I wish. I don't know how to find them. I've looked at things. They don't generally look that good. I'm surprised by how expensive some of them are. I passed on something that would have been very good that we, maybe should have done or whatever, but that was a while ago. So,
what was that company?
It was an oil company in the U.S. But we're talking a little while ago. But it's not cheap now compared to these other ones that we're talking about. That's part of the problem. So there's not a lot of small oil companies that are all that attractive. I've looked and tried to find some. There's some that people talk to me about and stuff. They have some hopes for, but it's more. I mean, the ones that that are very small are a little more marginal in terms of their whether they'll actually get royalties from it and stuff. They own a bunch of stuff, and without a high oil price, I don't know how much will actually be produced and how much they would make off of it. But then there's probably not a huge downside risk because they're selling for not that much different than like what they're worth otherwise. I did look at, I looked at one other thing that was interesting. Very small, very hard to get. So what's Occidental's market cap?
55.5 billion.
Okay. So I looked at something that was like, let's see, 1/20,000th the size, something like that. And that was very reasonably priced or something, but very hard to get. So generally, I found it like impossible. Like people would like to hear, oh, do you have a $300 million to $3 billion type, stock, something with some liquidity but overlooked and stuff. And I don't. Like I said, I passed on one thing in that category that shouldn't have, but we don't really do energy companies and stuff. And I mean, Buffett did this before. He's bought oil companies in the past. So he bought, in the 70s, he sometimes bought things that were in other categories of inflation protection. And he even bought oil companies in the 2000s before the, both in the oil run up. Then he bought PetroChina, obviously, and did well in that. But he also bought, I guess, ConocoPhillips then. So he's got two big ones now, Occidental and Chevron. Chevron actually is bigger in terms of Berkshire's weighting in it, right? But Chevron's such a bigger company, it's a smaller percentage of the stock they own. But between the two of them, it's a very big position. I mean, we could probably... Do you have like Data Roma or something for that? Because if we combine the two companies, we could get an idea of how much he's exposed to oil that way.
Why did you pass on the smaller company? Was that a style thing? Was it because there's a few things that you didn't like about it, or what?
No, that's the problem. Just because it was an oil company and they don't buy oil companies and stuff. That's the illogic of it. Okay, so how much Chevron do they have? Yeah.
They own 162 million shares, 29.2 billion.
Okay. And Occidental?
12.2 billion. Ish. I mean, this is not updated because this goes by the 13 F or whatever, so it's a little bit more than that.
And as of the last quarter, the last 13F that they have there, what were the percentages of the portfolio in each of those?
According to this, Occidental 4%, Chevron just under 10%.
Yeah, so other than Apple and Bank of America, let's say Bank of America also, there's, which we've said are very big investments for them. It's their sort of single biggest thing because the other ones don't fold together, the positions in them normally. So, that's what Buffett is in. He's in the oil companies, like we said, U.S. oil companies. And he's in Bank of America as his bank. He's been eliminating the other banks. And we know he's in Apple in a big way. But that's a huge portion of Berkshire's portfolio if we just took those three together. Those four, technically, because Chevron and Occidental are two different companies, but he's buying them like they're, the same sort of thing or whatever. So.
And you still think it's a bet on higher oil prices and at Occidental, the change in capital allocation?
Well, higher oil prices and the capital allocation, obviously. But the capital allocation determines the capital allocation determines the oil price. I mean, from the industry as a whole. So the important thing is that the industry not overdo it in terms of capital allocation, which they've been sufficiently careful about so far. So yeah, I think that he's always been betting on higher oil prices over time. He's talked about that before. So, and then the capital allocation is really an issue of if they do that or as long as they don't do other things that aren't smart. Right now, it's in a sweet spot for capital allocation stuff because it's a sort of a declining industry. It's a no growth or declining industry, but it doesn't see itself, most of them, as being existentially threatened. So that it has to go and buy random things outside of it, which may happen at some point, but that hasn't happened yet. So they, there's some companies that are in carbon capture and stuff, but they aren't just randomly like, we have to buy solar and wind and, buy an electric car company or something. So because they're not doing that, they're in a really good spot in terms of capital allocation in the industry. But it's hard to tell because in the 70s, it may have looked like oil prices would go up for a long time too, because at the time, U.S. oil production and stuff was not going to grow. They knew that. And it didn't for a very long time. And then, decades later, it was possible to grow and everything. So, what's the book I was thinking of? Is it The Prize? There's a book that's about the oil industry, the history of the oil industry. And I think that people can read that one if they want for an idea of it. What's the epic quest for oil, money, and power, The Prize. Yeah. So there you go. So if you go to Amazon or anywhere and you buy The Prize, that will be a good book to understand this, because constantly the expectations for what it'll be a few decades out are way off, right? So they're always surprised by these things that happen. And
why is that?
It's interesting. Well, one is it's a globally traded commodity, so that's a huge part of it. So that's a big part of it. Two is they're wrong about a lot of things. I mean, we adjust these things over time. So if you say, well, people include in their write-ups of Value Investors Club or whatever, here's what the electric vehicles will be this year, this year, this year. Well, if you keep adjusting them and never go back and see what did people predict in the 10 years ago for something, then it doesn't look too bad. So I think the biggest issue is that it's very difficult. It's the same mistake the Fed made with interest rates and stuff. It's very easy to fool yourself when you're not quite at full employment, that you won't have inflation if you get to full employment, that it's not having a big impact, right? It's the same sort of thing with oil. At times they can think that there's not enough oil because the situation's a little tight and the pricing isn't that great. But if the pricing goes stratospheric, then it'll unleash a lot of activity that people said they weren't going to engage in before. So, we have $70 barrel oil or something now. Let's say 70, 80, something like that. If it goes to 200, then the predictions are out the window. Because whatever the companies are saying they're going to do, at 200, they'll behave differently. So that's part of it. And then at other times, it was just complete changes. Like the 70s is a good example. So before the 70s, no economy had grown. No economy had grown without growing its need for energy at the same pace or more. No economy had ever become more efficient in terms of its energy use. In the 1970s, the U.S. does, and it never gets back below that level. So the U.S. basically, you can argue about this because a lot of things have been offshored and stuff, so maybe what the U.S. consumes has a high energy content. But, in terms of its GDP per capita versus its energy use per capita, of fossil fuels, it's been down for 50 years. It's flattened down. So the people are living a higher standard of living than they were 50 years ago, and they're consuming about the same amount in terms of like gasoline and stuff. That was unimaginable. So, economists and stuff in 1972 would have said that can never happen because it never had happened. So that was the whole idea that you could conserve energy and increase. And the reason why is pricing. If you increase the price that people have to pay for it, then they'll figure out how to become more efficient with it. If that hadn't happened, people wouldn't have figured out how to become more efficient, right? If oil prices had come down instead of up, then people don't have to figure out different ways to save a lot of money. So that's what mostly drives it, is that if it's a very big expense and they realize it, then they have to deal with it. Then it changes all sorts of behavior across the whole economy because it's being rationed that way. So it's really hard to predict how people will behave by asking them ahead of time. I always complain about those polls that say, will you drive less or something if oil is $6 or like it comes up with these numbers and people say yes or whatever, but we don't know until we do it. I'm sure people said I'll buy a lot less eggs or whatever, and then eggs double, and they say, well, I still need to eat eggs. So it's very hard. It's very hard to know is the answer with that kind of thing, because you don't see it predicted ahead of time in terms of like what people's behavior will be. It's very hard to know what will happen. Like how would we predict how many cars Tesla will sell or something? If Tesla was priced it made the same car at the same price for 10 years, then we could predict better. But if it keeps getting cheaper, better, whatever, then it's harder to predict what that will be. And then at some point that doesn't keep improving at the same rate that it did before. So again, becomes more difficult to predict. So, they're basically extrapolations of recent trends is usually how they do these things, and yeah. So, but you read that book probably every 20 years or something, the world was wrong by a lot in terms of what it expected oil supply to do.
So we've spoken last year a lot about the JetBlue and Spirit Airlines merger. Yeah. And I'm just curious, Geoff, if you think that there's some opportunity in the market for a merger arbitrage, and if this would be a situation that you would be interested in. The Justice Department is suing to block JetBlue from buying Spirit Airlines. Just as a refresher, the deal is for $3.8 billion or $33.50 per share. Spirit Airlines, I pulled the screenshot earlier today, is currently trading at $17.13. So there's just a huge gap between the takeout price and where Spirit is currently trading. I pulled some information just from reading about it. The U.S. Justice Department has filed a lawsuit seeking to block JetBlue's proposed $3.8 billion acquisition of Spirit Airlines, arguing that the deal would hurt competition in the airline industry and lead to higher fares. Let's see. JetBlue and Spirit plan to fight the lawsuit, with JetBlue CEO saying that the deal would ensure customers get a competitive airline marketplace. The Justice Department has been concerned that previous airline mergers have reduced competition in the industry, and under the Biden administration, blah, 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 blah. JetBlue and Spirit overlap on as much as 11% of nonstop routes they both fly, and JetBlue has offered to seek the divestment of all of Spirit's holdings in Boston and New York, as well as 5 airport gates at Fort Lauderdale, Florida. The part that I thought was interesting, the deal aims to expand JetBlue's nationwide presence, and JetBlue has said that it intends to repaint the airline's bright yellow jets. So basically take out the bright yellow jets, the ugly jets, while tearing some seats out of Spirit's more crowded cabins. And the Justice Department is basically saying you're going to raise prices if you do that. And they said that JetBlue effectively has acknowledged it would raise prices by predicting that it would reap 24% more revenue per seat than Spirit earns today. So just kind of curious to hear your thoughts on the difference between the $33.50 takeout price and where Spirit Airlines is currently trading. If you think there's an opportunity there, I believe we have spoken about different situations where you had said you would be interested in a merger arbitrage situation if you would feel like, well, where it's currently trading, the market is actually cheap, where if a deal doesn't go through, you would still buy it today. Does this fall under that cheap framework? Yeah. Okay, because we've spoken a lot about airlines, so I'm just curious to hear your thoughts.
Yeah, Spirit's cheap. It probably, if you valued it like a normal stock or something, it'd probably be worth $30 a share, probably, something like that. The deal's for around there. There's a little more complications than we mentioned here. Spirit there had been a payment before that happened with the deal, and then they also have like a ticking clock that they have to keep. JetBlue is effectively like renting the Spirit shares. So I think it's paying 10 cents a month or something. You have to, I'm sure people could look it up, but I forget what it is. But at the current price, it might be 8% yield or something that they are paying just to, if the deal continues up to a certain point. And then there might be certain ways that they could get out of that or something, And obviously, these companies can renegotiate things. But you're getting some other stuff. Yeah, the stock would be trading higher, I think, if there wasn't a deal in place. But it's not that far out of line with other airlines, which also are about this cheap, that they're worth probably about twice what they're trading for. Spirit has a lot more leverage than something like Southwest. So if you kind of dig through the balance sheet and stuff with Southwest, you keep finding, there's more assets than I thought and everything, and less liabilities. Spirit, it's the opposite. There's a bunch of liabilities and stuff. So it is more, it's more leveraged to what it could get there. If we just look at the history of the company with QuickFS, we can see that it did, let's see, what was last year's revenue for them?
Last year's revenue for Spirit was $5 billion.
$5 billion. The worst year, I believe, for operating income in Spirit's history that I know of is about 8%. On a 3-year basis, I don't think they've actually done worse than about 10% EBIT. So that would suggest that their earning power would be about $500 million normally. You could say it's a little bit worse or something, pre-tax. And then, so after tax, we could round it down or something, but you're still, there's no way that after tax you aren't getting numbers that are like 350 million or something, but that would be using the entire, that's without adjusting for the fact that they're paying on certain things, but of course then they're not using shareholder money. So I'm trying to adjust it. So using like the operating income, a lot of people would just do that against the enterprise value. And so they'd say, it's trading at less than 10 times or something. 10 times is about, so like it's probably trading at 7 times what you'd expect EBIT to be in the future. That's, if they kind of achieve that, because they've never had particularly low operating margins that I can think of, Spirit. Spirit's a weird airline though, so I don't know if I like it as much. That's the hard thing. As like a Southwest or something, it's not as plain vanilla and easy to predict. Most of its revenue comes from add-on fees. Its seat revenue for actually selling the fare is less than half of all of its revenue. Everything else is you want to bring a carry-on, you want to have checked bags, whatever, and they add it on. Certainly, as the Justice Department said, it's going to cost more to fly JetBlue. However, JetBlue is going to provide you with a better experience. So if the idea is just to have the lowest possible fares, then obviously everyone operating like Spirit or something would give you lower fares. I mean, if you compare fares on, Southwest or something, you're obviously can bring carry-on, and you can also bring two checked bags and stuff. So there's obviously a major difference, which when you add that in, that's half of Spirit's fare. It's like, I looked it up. It's I think even a discount airline, original discount airline stuff like Southwest is providing stuff to you that Spirit puts like a $70 value on or something per ticket, something like that. So obviously, if they're doing fares, the Justice Department, then they're going to say that they're going to raise fares, which is true, and they're going to take out seats. So if they're going to make more money per seat, then they're obviously going to reduce capacity.
So tickets are going to go higher.
The ticket prices, yeah. Spirit's ticket prices, however, are irrelevant. I mean, like I said, the actual price is usually more than double the ticket price. So, like, the ticket price is a teaser to get you to book with the airline, and then the actual price is different. So, the average person is spending more than twice as much on Spirit than the advertised fare. So the airlines match well in terms of the kinds of planes they operate and stuff, but like they said, there's not a huge amount of overlap in terms of the gates and everything. So I don't know that it's
an interesting play because it's one where the merger or for example, the merger could not go through and the stock could be up a good amount on that news because it's just trading so cheap. And even where we currently are sitting, I mean, we're not that much higher. I mean, we're probably right where it was when it was announced. I'm assuming if
you're at
there,
almost,
I mean, the stock hasn't gone anywhere.
The stock has almost never been this cheap, right?
I don't think so. We could look at on a long-term data, but certainly from a 10-year perspective, yeah. No, I mean, you're right. It's probably the cheapest it's ever been.
Yeah. So, I mean, I may have a very my overall conception of the airline industry and stuff may be very wrong. But you obviously, and you had another bid, obviously. So you had two airlines trying to buy this one. Mm-hmm. The issue, of course, is that although we know that the value to a private owner, to a takeover in this case, is greater than the stock price by a lot, it maybe can never happen because it may be that the government will never allow it, that this airline can never be bought by any other airline. And so in that case,
but that's okay though if you're buying today.
Well, what's this airline going to do though? I mean, we can look at what their past history was. So you have operating margin there going back. Can you tell how low the operating margin got before the pandemic? I'm ignoring the pandemic. That might be controversial, but I'm going to ignore the fact they lost money during the time when they weren't flying.
Just don't use the C word. That's all I'm asking, so we don't get flagged. 2010, 9%. It looks like was the lowest operating margin. Okay,
9%. All right. So, what's the right EV to sales on something that's worst year was 9%? And as I'd say, I think you should use 3. I would always use a 3-year average. And if you'll notice with airlines, normally what will happen, as you can see there, I think, is you probably had a particularly good year right before you had the bad year. You don't normally have a bunch of bad years in a row like that. But let's say 9%. And what's EV to sales on the stock right now?
We have prices. We could pull up EV to sales. You're currently at 0.7.
Okay. So it's quite cheap. So you'd have to be around 1 or something to have like a PE around 15 or something, Of course, like I said, this does have liabilities though. So that is something to keep in mind. It does not own all its planes and things like that. So it also has some debt. Whereas like on a net basis, I would say Southwest really doesn't. Southwest basically on a net basis owns everything. It has as much cash as debt. Is completely clean balance sheet and stuff. So you do have some more risks here. And I also don't know that
and it's priced about the same way too.
That's the problem. So, I mean, here's the thing. You can basically buy Spirit, and if you like it as much as other airlines, it's priced about the same. All airlines look cheap to me, and you have these deals in place that could go through. They have a deal that they could win, obviously, and it could go through. They could choose to fight it all the way through and win, and that's possible. Or there could be another deal with someone else at some point. or they could just continue as a business. I don't know. I'd have to check. I'm not sure if I'm as comfortable with like the long-term capital allocation stuff of Spirit if it stays independent as Southwest. But so I think certainly, like, if you're asking, I mean, it's of a stock that supposedly someone is buying out. It's incredibly cheap, right? It's like the cheapest. I mean, anything that's being bought, I mean, Activision's really expensive, what Microsoft is paying and stuff, versus something like Spirit is really cheap. So, but the belief is that obviously it's been baked into the price, and it's gotten worse and worse over time, but it's always been baked into the price that this deal is not that likely to go through. So the downside here is if you buy Spirit, how much of it is really uncorrelated to the market and stuff and event driven, and how much are you just going to end up with owning an airline stock? But either way, I think it's probably better than owning like the market or something. So if you wanted to be just own Spirit instead of owning whatever else, I think it's probably better. Probably. But just, I think a lot of people would have trouble stomaching that, though. Deals falling apart and all of that. So, but yeah, I'd expect in the long run that the stock will go up if the deal doesn't happen.
For people, though, that have a problem with stomaching it, I mean, do you think Spirit is a good play? Because in the event that it doesn't actually go through the deal, it's like, wow, the stock could rip on that news because of where it's trading. Super cheap. Or maybe that wouldn't happen. But, I mean, it's trading cheap today, where even if you're looking at it as just a normal stock investment, and as you had said, those are typically the best plays to look for as it relates to merger arbitrage.
Yeah, I agree with that. But obviously the market doesn't see it the way I do. Because if it did, then it should be trading with very minimal spread. I mean, the math of what spread it should trade at is not just based on the probability of it going through. It's the probability of it going through times the percent of the gain that you would have potential versus the probability of it not going through versus the percent of the loss. In any case, if a stock is likely to trade at the level of the buyout, then it needs to trade at no spread. Because when you multiply the probability of the loss times whatever the severity of that loss is, the severity is going to be nothing. So if you think this is like a $30 stock, if it's just free to trade in the long run, which I would assume that about $30 is right. It's hard to come up with something that's less than, I mean, where it's trading now, the things you have to input to try to get a $20 price on this are pretty aggressive assumptions. Now, you can assume that the airline business gets a lot worse, and it could with things like labor, And so the airline business could always turn down. You could assume there's about to be a recession. You could, there could be concerns for a lot of things. But yeah, I mean, if you try to value it like other stocks, say it should have a multiple like other non-airlines and stuff, and use past data to do that, you're going to get a price in the 30s. So
how long could this take to work its way through the justice system?
I mean, it could take a while. So it could take a while. There's not a lot of ones that actually go through all the way. This looks like it might, from what they're saying, like that this will really happen. A lot of times they back off when this happens, and obviously the government a lot of times does not go through with things. It tries to get a lot of concessions and stuff normally ahead of time, agree to a deal instead of having to actually try it in court. However, antitrust stuff does go to court more often than like SEC stuff, which like never does. Yeah, I mean, it could take a long time, but like I said, unless they change the terms of the deal, you're collecting more on Spirit shares, is my memory. A lot of these articles, that's the other thing. Like we pulled from stuff, like the articles don't necessarily explain it as well as I would like. For instance, like when they talk about the price of the deal, they say it's 3 point some, right? What do they say it is? 3.8 billion.
Yeah.
But that doesn't make sense, because if I add all the liabilities that I just said plus the market cap and stuff, I get a number that's bigger than that. Plus I said that there's interim payments and stuff. So I don't know what, I don't know what that is. Are they doing only equity? I mean, JetBlue is going to assume whatever liabilities Spirit has and stuff. Plus, the deal has to take some amount of time to close, and they have to pay stuff in between. So I wouldn't say that those are accurate. And I looked through a lot of articles which didn't get into the details of the original deal and what it is. So you need to look it up in the SEC filings for Spirit. Spirit's ticker is SAVE. If you go to, so SAVE, if you go to the SEC stuff, you don't have to do it now, but people can do this at home. You can find the original deal and what it is. I think they had an 8K at some point where they said, we're not doing the deal with Frontier, and we're doing the deal with JetBlue, and some updates on it and stuff, or they updated. There's a very recent 8K where they give an update of the deal as it is, but you'll have to find that kind of thing to actually read the terms of it and stuff. Kind of like you can be a stock market genius going through it and reading all the stuff that's actually in there. But yeah, I would say the thing is, there's some chance that a deal could go through or someone could buy it at a higher price. And it just doesn't seem like, why would it trade at a lower price? I don't know. But against that is the problem that if you look at most airlines where Spirit is trading as if it's like other airlines, that no one's trying to buy it and that it's just trading like them. So I wouldn't say it's necessarily cheaper than other airlines, or that you'll necessarily do better in Spirit than you would in other airlines if they didn't have the problem. The other thing is, except for antitrust issues and stuff, since there's so much volume anyway in airline stocks, and then you have this arbitrage thing, it should be easy for anybody to buy as much as they want. But I haven't seen things where other people have come along trying to buy up a ton of it, given how cheap it's gotten. Yeah. So anyway, it looks cheap. But
if you were managing $10 billion, would you be interested in it? In purchasing it?
Yeah, if I was managing $10 billion, I probably have like 25% of the portfolio in 5 different airlines.
Wow. Well, there you go.
I don't see any industry that's as attractive as the airline industry that I can tell. I mean, look at their prices, right? What can we find? I can't find. There's few things that I can find that are even. Airlines are like literally 40% cheaper or something than almost any other industries I can find. Maybe energy and stuff that I don't understand well enough. I mean, let's take, what are their price to EV to sales on these? What are
American,
the EV to sales?
American Airlines 0.7. We said
0.7.
United was, we said Southwest was 0.7. We said Spirit was 0.7. We could look at United right now. 0.7. They're all 0.7 times. Yeah.
Okay.
EV to sales.
0.7 times. All right. So that's EV to sales. Now, we know, I went through some government data with you and stuff, that the operating ratio for the industry overall in the years before the pandemic was around 85, right? So for these to be priced as expensively as other stocks, so to do that math, we have, let's say, what would you say? Schiller, what's a normal PE in your mind? What do people say is the PE that's
15?
15. Okay. So we take 15. Tax rate is, we're going to say 25%. We'll be conservative.
Okay.
No, yeah, that's fine. So, no, let's say 21%. So, let's say 25. So we take 15 times 0.75, right? We do that. And then that will give us the PE, that will give us the EV to EBIT that it has to trade at, right? A stock to be at a normal EV to EBIT. Now, some of these are a little more complicated, like I said, because the liabilities and stuff, but we're seeing they're all trading around the same price. So for that reason, we would say that these stocks, it depends on exactly how you do it, but basically what you're saying is it should be like about 11 times or something. So what we're saying is like if you are trading at, so let's say 0.7 is a good example. So these, we know what they're trading at. They're trading at 0.7 times. Now, some of these might have convertible things in it that isn't captured by it, which could be a problem because they took deals and stuff. I looked into Southwest. It's pretty meaningless. So on the downside, it is meaningful. On the upside, your upside's a little limited because they'll convert. But what they should be trading at, so we can ask like what margin would they have? We said in the case of Spirit that their worst year was about 8%. We know, so Spirit's worst year was about 8%, and then we know that on average the industry before the pandemic had been operating about a 15% operating margin. So that's your sort of range, is about 8 to 15, right? Then you take that and you divide that into, like we said, the EV to sales, which is 0.7. So you take something like that. It's not even important to do that because we can see right away that all of those are too high, even the bottom range. And an 8% margin, 0.7 times sales is still too high. So what is the exact right number? I don't know. But I could see these things trading at 1.5 times sales if you thought that that was normal for them to earn margins that high. If you think that their margins will be a lot lower, then it makes sense that they, be priced lower. And maybe there's expectations that they will have much lower margins in the future. It could be possible, I guess. I'm not sure where it'll go. Maybe labor. Where does it leak out of? Is it, because why would it be price competition? Because if your load factors are as high as they are, then why are you trying to fill your planes up even more on the things? I mean, if you think about if the entire, if the entire network is on like a load factor of 80% or higher in some of these cases, I mean, that means that basically a lot of things are full. So I don't know why there'd be like a lot of price competition on that thing. I think the fundamental issues that restrict competition in this industry going forward are not solved one way or the other by this merger happening or not. I don't see that as a big factor in it. I mean, if you see Southwest and JetBlue, for instance, let's take Southwest and JetBlue. Some of the competition that they brought when competing is that that I think gets overlooked, is that they fundamentally increase traffic to other airports or at other times of day. So if you aren't an airline coming in and saying, okay, I'm going to increase, if there's 3 airports in New York that are popular or something, and you're not saying, okay, I'm going to increase afternoons at JFK when others weren't taking that time, or I'm going to bring a lot more traffic to Newark when it used to be at LaGuardia or whatever, unless you're doing something like that, like Southwest being in, we can use the example of Southwest. If Southwest didn't exist, if the government got what it wanted, FAA got what it wanted, there'd be no Dallas love. There are 2 major airports in Dallas, and one of them is there only because of Southwest. This is repeated over and over again across the country. In California and stuff, it's repeated. In Florida, it's repeated. Where there are major airports that are serving other kinds of airlines, where the budget airlines and stuff are in one place and the legacy airlines are in another one. And so increasing traffic to those places. If you want lower fares and stuff, then obviously you could build a lot more airports, make it easier to get to those things, do all sorts of things to support that. I don't think that the government is interested in having a lot more multiple airports around cities, a lot more gates, a lot of stuff like that. So otherwise, the thing is, I just don't see it. So, having other airports, so being served by more airports in an area, filling up more around the clock, and turning planes faster is all that I see in terms of the possibilities of really increasing competition over time in the industry and getting fares down. So, if you want lower fares, that's more what you need, is more infrastructure around things, turning the planes quickly and all that. I don't Spirit is a different way of paying, but I don't know that it's some huge difference. And as you've seen, Southwest over time got big. It converged with the other airlines, so that now the other airlines are more like Southwest and Southwest is more like the other airlines. So
I was just looking at that, Geoff. I was typing in on my other screen because that's where we have the recordings and stuff. I try to pull it through, but I was looking at Delta, and Delta is currently a market cap of 25 billion. Southwest, as we're looking on the screen right now, is about 20. UAL and American Airlines is around 17 billion. What do you think Southwest did? Like, what if you had to put something on why Southwest was so successful, and how before, Southwest used to look or be completely different than the other airlines, and now the other airlines look a lot like Southwest? What is it that allowed Southwest to become so successful?
Well, so Southwest was kind of lucky just in terms of when the time started. So Southwest started in Texas before deregulation. So Southwest is a copy of an airline that had happened in California. They had some issues, and they decided the model that they were going to adopt was a model that had been used in California earlier, which is to avoid regulations by the federal government by flying only price regulations and stuff at the time, by flying only within one state. And so they flew only within Texas. By doing that, they grew big doing that. And then when deregulation came, they spread out from that. Also, they somewhat maybe even benefited weirdly, or I don't know if they benefited. They might have been able to restrain themselves anyway. But with the issue with Dallas Love versus Dallas-Fort Worth, they had to agree to an anti-Southwest bill in Congress that restricted them. So basically, for decades, Southwest was only allowed to fly out of Texas into surrounding states, had to land, and then could fly from there to other states. So you could, for instance, fly from Texas to Oklahoma, but you couldn't just fly from Texas to Nebraska or something. You had to fly Texas, Oklahoma, then Nebraska. And that was a bill imposed on them because their competitors and stuff didn't like the competition they were getting from that. And there was all the things we talked about with Dallas Love and everything. So they did that. That combined with other things had them adopt the approach that they did. They also did other things that were smart. So one of them was that they did not spread themselves too thin in terms of how they went into markets. So their market share greatly underestimated like their competitive threat to other airlines, because like where I grew up, for instance, no one knew what Southwest was. They had no presence at all back then, 30 years ago in New Jersey, New York, that area. They did not have a presence flying up and down between New York and Florida. In fact, when JetBlue came in, they focused on New York to Florida, mainly because what JetBlue did is, and there's, I read some of the books on JetBlue and stuff and talked about this, is they basically said, what does Southwest not do? We're going to pick those routes that Southwest doesn't yet fly, or isn't big in, and focus on those. And Southwest had left an opening, which was that they did not want to go into congested airports. And so, because it would mess up their turnaround times, and it would mess up their whole network that way. And they were not willing to analyze too carefully if there were ways around that and that they could still operate effectively. And so JetBlue focused specifically on those. So it's not like an accident that JetBlue started with a big New York focus thing. They did that because they wanted to avoid competing directly with Southwest. And so what Southwest would do is they go into an area, they'd get a lot of the traffic immediately because they would go in a big way. They never went in small into a new market. So instead of having a small presence in a lot of different markets, they would go very big into one market. They take a lot of the share very quickly. This is usually what happens in airline things. You take a lot of the share very quickly. It settles down fast after that. But there's a brutal period, just like there is in a ferry business or a bus business or whatever. If there's direct competition, you can lose a lot of money. But all airlines in the flying in there can lose a lot of money in a short period of time, and then one of them pulls out, and leaves it to the other, or they settle down with whatever percentages it's going to be. So totally different model that they had. And then as they grew over time, sort of like when we're talking about Walmart, Southwest and Walmart grow up around the same time period roughly. They start to shift like in the 90s and stuff where some of the results ramp down. Certainly, as we saw, their results get more in line with others and all of that. And then the other ones obviously merged a lot over time. The big thing that we talked about is really that there's a period where the new entrants died off. There's a huge amount of new entry, and then that slowed down dramatically. So like in the 1990s, there was dramatic new entries, and I flew some of them. So for instance, I flew airlines that flew just from New York area to Florida, and that's all that they did. We talked about, what was it? Harbor Diversified. What's the name of the company? The OTC company.
Harbor Diversified.
Yeah. Mm-hmm. So that's Air Wisconsin. Like those things were actually airlines at one time, and that operate on their own. Those kinds of things, even small planes like that. Those are really small Canadian planes that were originally meant to be private jets that they started using for passenger stuff. Those companies like that, at one time, many of those planes for companies like that were actually airlines, different small airlines. And then they either became the express service of these, whether it's Delta or United or whatever, or all these companies that merged into them had their own ones that did this, that fed in. And they, instead of having to compete with them. So they don't compete with them. Instead, those airlines bring people to the Chicago or wherever they want to move them from. And I think in that case, that's where they're moving them. So a lot of those airlines went down. I mean, I think I talked about that. The numbers are dramatic that way. I mean, of the new entrants, the numbers coming down is big. So the number of airlines on average has been declining for 20 some years or something. But, but that's not that weird. Like, it's hard to say how much of an effect that has and everything, because we've talked about, the number of public companies has been going down since, until the SPAC stuff had been going down since the early 2000s. In the United States, almost no banks were being formed after the financial crisis. And but like at first they're small, so it doesn't immediately have that huge effect. The fact that no banks are formed in 2010, 2011, 2012 isn't having a huge effect, but in the long run, it may have a big effect. And so, yeah, I mean, that was one of the very big points that I took away from the government statistics on that, is how much the increase was purely from about a 15 or so year period. That from deregulation happens, it takes a couple years till things kick in. 90s very big in terms of the number of companies being formed and the competition that you can see and stuff. But by the later 90s, things calm down a lot, and it seems like there's a big shift in the industry, and things keep getting better and better from that point. This is disguised by, so let's say 1997, is where competition turns to where it's now becoming a less competitive industry or something. I don't know if that's the exact year, but there's certainly a strong trend of the last 25 years or something of decrease in competition in this industry. But that's disguised by there's 2001, everyone loses money, right? Then it happens again in 2008 because you have September 11th, you have financial crisis, and then you have the pandemic. So basically you have those events. And so it was easy. What I was saying is it's easy until looking at it to realize, this is disguising a lot, that these are one-time events. We talk about non-recurring things all the time, right? And usually they do recur and everything. So when looking at it, I talk about the semiconductor industry or something. I'd look at the airline industry and say, oh, well, how different is it really? I mean, yes, maybe it's gotten a little better or whatever, but it looks a lot like that. But, it's different because 2000, the semiconductor industry implodes, and so does the airline industry, 2001. But the difference is the bubble things that happen with semiconductors are maybe somewhat recurring phenomena, right? But the terrorist attack is not. Financial crisis is a terrible financial crisis that's not brought on by the airlines themselves. That maybe it's a once every 50-year event. I don't know, but it's not a very common event. And then pandemic. And, with the exception of the financial crisis, I would expect that certainly the response would be totally different if these things happen again. So I don't think that air traffic would end up dropping anywhere near as much in the next pandemic. I don't think that in the next terrorist attack, the traffic will drop the way that it did after the first one. So that's just my feeling on that. And if you take those kinds of factors out and think about it, then you go, oh, the industry is pretty good. The offset to that is those problems may be why the industry is that good. Because those weird recurrent one-off events that happened may have actually discouraged people from starting airlines, may have forced airlines to merge together, it may have been those events that actually created a lot of the less competition and stuff because there were so many adverse events happening. So that could be the offset, whereas if those things don't happen again, eventually the industry will get bad. And that's probably, that's potentially true at some point. There'd be a lot more competition and stuff. So it's possible.
So Spirit Airlines or Southwest, gun to your head, what do you choose?
Well, I would choose Southwest because I don't mind being in airlines for the longer term. But if you're just looking, you don't want to be in airlines, but you're looking for something to own this year for whatever reason, then Spirit sounds fine.
Mm-hmm. Got it. Cool. Well, I want to thank everybody so much for tuning in with the both of us on the Focus Compounding podcast. If this is the first time you are tuning in, be sure to check out all of our work. Best place to do that is to go to focuscompounding.com and follow me on Twitter at Focused Compound. Wherever you are listening or watching us right now, make sure you hit the subscribe button and a thumbs up, leave a rating and review. That all goes a long way for us. We are going to be in Omaha this year for the Berkshire meeting. We will be there the week of. The actual meeting is Saturday, but we are planning to be in Omaha for the entire week. So if you are interested in learning about our money management services and would like to schedule a meeting, you could reach out to me at andrew@focuscompound.com. We'll sit down, grab some coffee, and talk about everything that is focused compounding with Geoff and myself. I thank everybody so much for all the support, and we'll see you in the next podcast. Take care.